Right folks, it's Sunday the 10th of March. We've got the non-farm payroll number out of the way for the month. We were looking at the dollar index chart on Friday. A lot of action around a lot of price action around the 97.5 area, going back as far as August last year. In fact, we had peaks up there in August, July, August of last year, peaks up there. When was this now? This was, sorry, not last year, that was 2016. 2017 we had peaks up there as well in the middle of the year. And then, of course, at the end of last year, we had a lot of congestion up there around the 97.5 area, 97.69, 97.53. This peak up here is 97.71. So I warned that that was obviously an issue for us this week. 97.71 was the high on Thursday. Now, I didn't have the nuts to enter a short before the non-farm payroll number. I kind of have a rule that I don't trade over those numbers because it's just a gamble. Wish I had done. If you did, well done. We got to 97.71, as I say. So, you know, this little trend line that I showed you on Friday certainly worked. We reversed on Friday. So we've rejected the upper end of this triangle, rising triangle, at obvious resistance. The question is now, do we return to the 100-day moving average at around 96.53? 55-day moving average at around 96.30, and maybe even we test the lower end of the triangle sideways pattern thingy at 97, 95.70, 95.70 by the time we get there with this little rising trend line. Obviously, a break above 97.80 is going to clear a path for the beginning of a new leg higher, but that hasn't happened. So that's where we are with that. I would be tempted to short if we got anywhere back up in the 97.5, sort of 97.50, 97.70 area, wishing that I'd done that on Friday, maybe with a stop above 97.80, in the hopes that the market does return to those levels that I've just mentioned. This horrible sideways chart for the Aussie dollar does give us a reason to believe that we will recover from the oversold situation again with that weaker dollar. So we've got a bullish engulfing candle here, so wouldn't be surprised to see further gains. The levels are on the Aussie dollar sheet, but 1 second. Just checking those levels. So 70.70 would be the first resistance. It's only minor, but we should stall there at least in the morning. So if you're looking for a scalping level, 70.70 would be a nice little scalping level. Maybe you can nick 20, 30 pips out of a short there. Break above 80, then we're going to a much stronger level, which should be around 71.20, 71.30. That's up here. That would be worth trying a short. I doubt we'll get there on Monday, but who knows, we might get there in the middle of the week if we continue this recovery. And then I would be selling it around 71.20, 71.30. You really would need a stop above this trend line and moving average. It's so far away that I'm not really looking at this as a level. We'll tackle that as we get there, if we get there later on in the week. New Zealand dollar also a horrible sideways mess, but obviously weaker US dollar saw the New Zealand Kiwi head higher. So we held the 200-day moving average, which we hadn't done so well previously, so I wasn't going to take that as a long position. And we've rocketed up to the trend line here. So the question now is, do we hold the trend line, which is around 68.00, 68.10. If we do hold that, obviously we'll reverse back down to the 100-day moving average at around 67.75, and then we've got the support down here at around 67.40. So I'm not excited by this chart, but those would be your scalping levels. Right, the yen I was really pleased with. I was talking about getting into the yen, buying the yen on Tuesday, I think Tuesday and Wednesday, and that obviously worked. And Friday we saw a good old plunge on the dollar yen down to 110.77. So if you were long the yen and you took some profit on Friday before the non-farm payroll number, that worked quite nicely. I'm not really sure what to do with this now. I don't want to push my luck and look for more trades on this because this is not really very clear. Obviously we are in a bull trend, so I guess we've got to stick with the bulls. We were lucky to have caught that counter trend move, and you can see we bounced off the lower trend line. I think my best suggestion would be to trade in between the 100-week and 200-week moving averages. So the 200-week moving average is declining slightly. We will 112.20, 112.30 would be the selling area. We got to 112.12 last week. On the downside, we've got support from the 100-week moving average at around 110.90, 110.80. I think that's my best suggestion. You can see it's just again a horribly sideways chart. So that's my best suggestion, really. It's the weekly chart giving us the clearest picture for the euro yen too. The 200-week moving average obviously did its job. We were looking to get short up there anyway, so I'm pleased about that. That certainly worked. We had a big down week last week. So if you decided to buy the yen by selling the euro, that really worked even better. We've got support from the 500-week moving average down at around 124.00, 123.90. We bounced just above there. I actually had a buy level at 124.20, 124.10. I had it a little bit higher, and we bottomed 6 pips above that. I hope that helped you. If you managed to jump into a long on that, that obviously worked. Or certainly if you managed to cut your shorts out just above that support level, that would have worked really, really well. Yeah, I would say in between those levels, I know they're very far apart. They're over 300 pips apart, but the short-term charts are not really giving me any clues now. This is the daily chart. It's just a bit of a mess. I don't want to push my luck. As I say, we had a good move in the yen last week, and we caught some good profits. I think we should just sit and wait for the next signal in the yen. Trying to make some sense of the euro dollar. You know, when you look at this bigger picture, just a big sideways trend for months, and you can see with the daily candles, we're up for a day or two at the most before we reverse. So sometimes we get 3 days. It's just so difficult. You certainly couldn't run a trade for more than 2 or 3 days, and at the moment, if you're trading intraday, you notice that you can't really run it for more than 2 or 3 hours before we get some sort of reversal. Well, we did get a big move down on Friday on the ECB thing, but that would have been just a gamble on the ECB announcement. That's not really the way we trade. However, we are carving out a slightly downward sloping channel, you can see here. So I guess that's why we bounced. It was not really a strong enough reason for me to be recommending a long for sure, but now that we have bounced, maybe we'll get up towards the 113.17 level. I can't really recommend a trade in this. You know, if you want to trade that channel, fair enough. You know, if we got up around the 113.70 area, that would be a nice little short. I've got 113, the middle of the Bollinger Band. I would try short 113.20, 113.30, just above it would be where I would sell it if we get up there. But right now, I wouldn't have anything to do. I'd just have to sit and wait. Canadian dollar had a great run up last week. If you managed to jump onto that long that I suggested on the break above the trend line and the break above the February and the January highs, then you've done well. Hopefully you took some profit, took all your profit on that before the non-farm payroll number, because that obviously sent the US dollar lower, so the Canadian strengthening. I think we'll see some follow through on this. I think we'll see some follow through to the downside. Would I be getting short of this? It would be a little bit risky because there's no real resistance up here. There was nothing telling me to short it, and we just moved on the number. As I say, I do think we'll see some follow through to the downside, and maybe we'll even get down as far as a 133.00 area, which I would, for sure, I would be buying it down there. We've got a little bit of support at 133.90, call it 133.95.85. So just watch that level. Where do we get to? Yeah, that's where the low on Friday anyway. So that would be your first support level if you're looking to scalp. And a break below there could actually take us down as far as the 133.10, 133.00 level this week. Gold, we didn't get my buying opportunity around the 12.75 area, which was unfortunate. We shot higher on Friday, again in line with that weaker dollar after the non-farm payroll number. We've got resistance at 13.01, 13.03. You can see from the Fibonacci levels in the 55-day moving average. It doesn't show it on this chart, but I've got stronger resistance at around 113.11, 113.12. So watch that level. We could certainly reverse from there. It's probably worth trying a little short. Stop above 13.05. It's very, very low risk. It's worth risking 2 or 3 points, because if we do go down, you know, there'll be 10-point profit in it. So I'd say that's a 3-to-1 risk reward ratio. But if we get stopped out, don't be surprised to see the market head up to 13.11, 13.13, and I would try a short up there. Now I'm speculating here because we have to wait for the pattern to complete, but I'm wondering, could this be a head and shoulders pattern? Small left shoulder, a big head, and then could we get another similar small right shoulder with a break below the trend line at the neckline at 12.80 to give us a sell signal? Obviously we would need to get through the low 12.70 area in order to confirm that, because there is some important support from the 500-day moving average and the 100-day moving average, so it's tricky. But anyway, we'll see if that develops. We don't want to be selling on speculating or hoping for a completion of the head and shoulders pattern, but we do have the resistance here anyway, so it kind of gives us a bit of an in. We could get in here. We could see if it trickles down to here. We could even cover half the short just in case it breaks lower. Then we've still got some short position on. We'll have a look at that later in the week. Right, in an attempt to find some opportunities in the Forex markets, I'm really going through as many pairs as I possibly can. Aussie versus the New Zealand dollar, where I think you can call this a descending triangle. We need to look at it on the daily chart. So, we have got this descending triangle. I'm pretty confident we can trust these trend lines. We've got to just tighten this up a bit. We've got some decent support down here if we keep going lower at 103.20, 103.15. Well, call it 103.25, 103.15. That's probably worth trying a little long as we get oversold. And then there's clear resistance from its upper trend line, which has worked really, really well for the past 2 months. We've touched that one 1, 2, 3, 4 times. So let's give it a go again. Make a note of this: 104.10, 104.20. Try a little short if we bounce there. You'd want to stop above 104.40. So it's a relatively low risk trade. 20 pip stop roughly. 20-25 pip stop. But if it works and we continue the bear trend, then that would work quite nicely because you've got potential 100 pip profit on the downside. That's the best I can suggest for that pair. I've been getting into the Norwegian kroner and the Swedish kroner thanks to my friend Gavin. Now then, we've got this resistance going back to the end of 2016, beginning of 2017, which I pointed out to you on Friday. The longs really, really worked last week if you managed to jump onto that. We got very close to this trend line, and of course, with the weaker dollar from the non-farm payroll number, we reversed on Friday. And we've got a negative candle here right at the top of that range. So it all looks negative now. It's an about turn for this market. I can't scrunch up far enough to get to that previous peak that I showed you on the weekly chart. I think we can get rid of this trend line. I don't think this is actually particularly relevant. So it looks like further dollar weakness in this pair, and this is a really nice double top too. So this could really signal the end of this bull trend, which started in March of last year. So it's a 12-month bull trend. Is that double top signaling the end of it? Let me look for some more evidence. Now I'm going through other timelines and I can't see any further evidence. But a double top at previous highs with a negative candle on Friday is enough to persuade me that this market could go lower. So let's see if we test 86.66, break below there, we'd be looking at the 86.58, 86.55 area. Okay, pound Swiss has been a bit of a favourite of mine over the last week or two. We've now finally, after a bit of chopping around, come down to the support level, which I pointed out to you. So 130.80 is a good level. 130.80, 130.70. If you're managing, or if you're interested in buying it down there, or if you managed to on Friday, you want to stop below 130.60. Low risk reward trade. If we do take off from that support level, obviously we could be looking at 132.00, 132.5, and a high 132 area before the 133.00, 133.30 area. So risk reward, that works really nicely. If we break below 130.60 and you want to be active in this pair, I would suggest you get short then. We can see further significant declines.